This is, can you see the screen?
Yes, sir.
This is what I sent. So there is one there's one topic selected like this: the falling CBSL reserves and the economy. Tirini, are you there? Hello? Tirini from Trigger Chapman, are you there? Hello, yes?
She has some problems. I'm also a cricket Chapman. We decided to do that topics.
Right. So the falling CBSL reserves and the economy, that's the topic you will work on.
Yes, sir.
Right.
Initially, we work on that rupee falling rupee and the economy, but you told change that to them.
Yes, it's better this way, eh? Because now you get more information on this. Right?
Yeah,
So you can discuss amongst your team and then come out with whatever the points that you have. And in between, we can also share with me what you have compiled so that I can also be of assistance.
Yes, sir.
Right? Basically, falling central bank reserves are due to a few reasons. One thing is that the COVID pandemic and then resultant economy slowdown. Several organizations, several business angles have been affected severely. The tourism industry is the worst affected. Sri Lanka was earning about $4 billion a year. Now that was brought to near zero. Then garment industry also suffered a lot at the initial stages, but they quickly changed over to COVID personal protective equipment, PPE kits, and then they recovered, but they really bounced back. Then the education is another arena that was affected. Schools and universities had to resort to online systems. And the most effect on the foreign reserves came from the foreign loans that were borrowed by the government, not by this government particular. There were several successive governments who borrowed up and above certain amounts, and they became liability to the government cash flows, and the annual debt repayment alone was estimated at nearly $4.5 billion a year. So that is one aspect that you can talk of, which will have a direct impact on the treasury market, where you are working on the economic activities. I think you did one of the assignments, the semester 2 or something, where you are suggesting that separate debt procurement office kind of thing to manage the foreign debt of the government, where that the debt procurement office can take over the entire debt, issue new securities or new papers, new bonds, and then supply the debt to the government and also the government entities like CEB, railways, then water board, Sri Lankan Airlines, such projects. And those bonds can be really managed by the debt procurement office, the repayment part, and also the new issues to finance the government. And the government can be free of all the problems that are arising because the debt procurement office can be used to manage the liquidity that become payable in connection with those foreign debt. And moreover, that sort of arrangement will deter any politician claiming underhand money and waste of finances, because there will be a public scrutiny and this debt procurement office has to be above board and can be audited. So therefore, the waste of, because we have found the analysis of some individuals that some previous governments had borrowed in billions and billions of dollars, but seemingly there have been no value addition, or there is no asset that can be defined out of those loans. So therefore, the money, the total monies at certain instances had gone waste, whereas the interest payments are becoming due, and the government, treasury, and the central bank is saddled with these huge loan repayments, whereas there are no assets can be identified. And ideally, when the loans are taken, if they are invested in, identified as assets, they should bring in some revenue for the repayment of the loan, whereas we cannot even identify the assets. So that sort of problems can be overcome by creating an entity like debt procurement office and let be managed by independent professionals of treasury skills. And another development in that aspect would be when the debt procurement office organize professionally the bond issues to be subscribed by the locals or world at large. You guys like money brokers will benefit to the maximum, where you will be involved in distribution or finding the best buyer, best seller in the primary market and the secondary market. So these kind of suggestions you can make in this topic. All right, so let's discuss some more in the future. Any others suggesting any topic? Yes. Can I hear from other companies? Yes. Trevor, can you suggest can you just have you thought of it even?
Also, we are still deciding it, me and my other fellow to Sajita and Lakshan.
But there are 3 people in your company, right?
Yes, and Iran as well, Kavishka.
Okay.
We are still deciding, sir.
Why are you taking so long?
Because this is a very small market, and we don't have such a lot of topics to suggest. Because past few assignments we have jot down each and everything what we are doing and market ethics and everything.
Okay.
We are still thinking about what are we going to do for the next assignment.
Yeah. Okay. So decide and tell me, right?
Yes, sir, definitely.
All right. Sachitra, what have you decided? So, Isru, any suggestions? Okay. So, please decide and tell me so that I can be of some assistance in choosing your assignment.
Sir, sorry.
Yeah, Nero.
We were supposed to hand in the or email the topic by today, right?
Yes.
We are actually still among the team. We are deciding exactly what the topic is. Is there an allowance for us to give it by tomorrow, sir?
Yeah, no problem. But you will take lot of time, but eventually the submission date also will come.
Yeah, submission date is 3rd November, no?
Yes, but the number of days will be reduced when the further you delay.
The issue we are having is for us to first decide on a topic that is relevant. So we will decide and email it by tomorrow, sir.
Right. Thank you, Niluk.
Okay, sir. Thanks.
So others also please decide on a topic and let us know. Okay. Right. Then let's move on to the discussion. Can you all see the screen?
Yes, sir.
Thank you. I think last we came up to this, right? The control framework, the segregation of front office, back office, middle office. Did we discuss this? We did, no? I think we came up to this slide last class. Just to recap, the segregation of duties and segregated reporting lines on monitoring by compliance. What I would highlight is that the case of Treasury Front Office, though they report to the CEO to pursue the business activities, the Treasury Middle Office and the Treasury Back Office are involved in the process, verifying and processing. However, the compliance role to monitor and review the activities of front office is there actually, but not many compliance departments of financial institutions understand this. Recently, there was a mid-sized financial institution where the Treasury Front Office were carrying on transactions regardless, but the rationale, economic rationale for the transactions for the particular institution was not established. And the Treasury Middle Office function where the strategic business targets and goals was not monitored, and not even by the Treasury Back Office. So therefore, and on top of that, compliance department have not been involved at all. So therefore, the institution was called up by the central bank to investigate and then employ external consultants and set up the treasury controlling mechanisms or review them afresh. So likewise, the strategic decision, including the risk appetite statement by the board of directors, and the board subcommittees, and also ALCO had not been perused so much. So actually, the functions of Treasury Front Office in executing transactions, the Middle Office has to verify with those economic goals set about by the main board and the board subcommittees and the ALCO. And thereafter, when it comes to Treasury Back Office, they need to again validate the deal tickets and the transaction that they see along with those set economic goals. In particular, Treasury Middle Office reporting to the risk officer. Their function is to minimize the losses and maximize the profits. In simple terms, when there are transactions happening without any economic rationale for the organization and incurring running financial costs, such as the processing of a transaction, the payments that are to be made in rupees or foreign currency, involving SWIFT messages, which is costly, and use of the Nostro accounts or the central bank account to make payments, involves costs, and the processing by the 2 or 3 individuals in the treasury front office, then at the treasury middle office, then at the treasury back office, their cost, overhead costs, altogether, if you add on all those costs, known costs, including the computer space that are taken to store the records of the transactions, will be something like 3,000 to 5,000 rupees per transaction. So where does the treasury middle office or the risk officer carry out their investigation? They must put their binoculars and then check on those costs. Why this transaction is being done, incurring 3,000 to 5,000 rupees per transaction cost, and whether actually this bank or this financial institution is reducing the loss or maximizing the profit in this particular transaction. They must be checking on it. That is why we have put monitored and reviewed by the compliance. So compliance in that case must be monitoring not only the treasury front office attitude and thinking pattern in executing transactions, they must also be watching the treasury middle office guys, whether they understand the job, whether they really know what they're doing, and if they fail to highlight certain aspects, it is up to the compliance department or the chief compliance officer who should be highlighting such anomalies to the board of directors or the board subcommittees, so that their level of understanding or misled attitude can be corrected. So by all means, some of the big banks and then mid-sized banks, the treasury front office guys are treated as superhumans, as if their job is secluded, and as if the others do not understand what they do. It is not true, and it cannot be. The treasury front office transactions, true enough, there has to be some sort of confidentiality, but to the risk guys at the middle office and then the finance guys at the back office, it is their duty to verify what are these transactions and why was then they executed. Then compliance guys must monitor, and if all three guys, the front, middle, and back office guys, do not understand or they do not have the attitude to check on it, the situation must be corrected by initiating action by the compliance. So this is extremely important. Otherwise, there can be a lot of malpractices, a lot of losses unnoticed. So various developments can take place to the negative or to the loss-making side. So this picture shows that when certain individuals pursue certain goals of making profits or adding economic value to the institution and to their customers. There can be some others who don't engage themselves to pursue such goals, which is detrimental to the effort of achieving goals, desired goals, set goals. At the same time, there can be another set of guys who work against or disengage. So, in other words, the set goals or profit targets let alone achieving them, these guys are driving on the reverse gear. The disengagement, the attitude that the set goals are ignored and worked against, meaning ideally they should be thrown out. Or alternatively, their attitude must be corrected. So this is a good picture showing how to correct the identified employees who not engage the set goals and disengage the set goals. Okay. So there are a few Parliament acts which are directly involved in treasury activities. Exchange Control Act 1953 had the provisions of appointment of authorized dealers. In other words, the Controller of Exchange those days delegated their power to the licensed commercial banks on approval by the Monetary Board with the commercial banking license. Another authority, another approval, another certification was given by the Control Exchange to buy and sell foreign currency to the general public to facilitate imports, exports, foreign travel, and inward remittances by expatriate Sri Lankans and many others. They had to obtain this license from the Controller of Exchange. Then in 2017, the word control was taken out. The word control was taken out, and then Foreign Exchange Act number 7 of 2017 was brought in. And then they had a special provision to appoint restricted dealers in addition to the authorized dealers. Now, those guys who were running money changing business at the street corners are required to obtain restricted deal license from the Foreign Exchange Department and then provide a minimum of 10 million rupee capital for each outlet, and also to voice record their transactions, and then also to fix CCTV cameras when they meet customers in person to record the images and the voice of the transaction. So those images have to be, voice recording and the images has to be archived for a minimum of 6 years. and also the voice recording and the other equipment in dealing rooms of large banks and finance companies also need to be preserved to identify any anomalies that may arise out of the transactions subsequently. Then there were a few other directions under Montreal Act 1949, Banking Act 2008, and based on these Parliament Acts, directions were issued by the Foreign Exchange Department, Domestic Operation Department, International Operation Department, Payment and Settlement Department, FIU, Bank Supervision Department, Non-Bank Supervision Department. So there is a comprehensive network of rules, regulations emanating from the legal enactments governing the treasury activities of financial institutions. That the performance management was entrusted to by the board of directors, entrusted to the ALCO and also the board integrated risk management committee. And there were at least two committees at the executive level, Treasury Committee and the Investment Committee, to discuss and then take decisions at the operating level on treasury activities. Whereas the strategic level and tactical level decisions were taken by the board of directors and the ALCO respectively. Then the regulators, the central bank, SEC, and in the case of insurance, it is Insurance Regulatory Commission of Sri Lanka, they issue directions and the regulations, and then they would want to see the reports coming out of these financial institutions and to ascertain their proper functioning. Then shareholders and the general public too are watching. Mainly the shareholders look for the profitability of the institutions, and when they are listed in the Colombo Stock Exchange, when the profits rise, the share demand for the shares goes up. And if at all if there are bad news or the news of loss-making entities, the shareholders sell their shares, and also new shareholders will not seek to buy the shares. So the price of the share will go down. Then the public, as the beneficiary of the services rendered by these intermediary financial institutions, again will be monitoring and then inquiring about the proper functioning of such institutions. Then the performance measurement criteria, the asset growth, the figures showing the asset growth, then advances and deposit growth. To achieve these performance measurement criteria, financial institution has to be compliant to the rules and regulations and then be attractive to the depositors and the investors. Then only they will have their liability book or deposit base to finance the advances, the loans and advances. Then the net interest income meaning the interest income from loans and advances minus the interest expenses on deposits paid to the customers, depositors, net interest income. Then net interest margin, the rate wise, if the loans are granted at 9%, and if the deposits are taken at 5%, 9 minus 5, 4% is the net interest margin. Then the CASA ratio, current account and savings account ratio. Current accounts and savings accounts are the low-cost funds of a deposit-taking institution. Other type, the fixed deposits are high-cost funds. So therefore, the amount of current accounts and savings accounts deposits as against the total deposits is the CASA ratio. And the low-cost fund CASA ratio, when it is high, the potential of making profits by this financial institution is greater because the net interest margin or net interest income will be higher. Then in addition, fee income growth. There's various commissions and fees are revenue by the financial institutions. So as their services expand, the fees and commissions will increase. And mind you, the capital gains or losses generated by the secondary market transactions of fixed income securities such as treasury bills and bonds also will be in this category, fee income growth. So therefore, the treasury dealers can contribute directly to the fee income or other income of the financial entity, and that performance will be recognized. So we come on to ratings, credit ratings. Fitch rating, I think ICRA is not there anymore, it's Lanka rating or something now. Moody's rating, Standard & Poor. They do look at individual entities, liquidity management, asset quality, access to liabilities and management capabilities, and then express their rating on that particular institution. I can remember when we started the Cargill's Bank, access to deposit liabilities, or in other words, access to finance, deposits or shareholder funds. When their mother company or parent company, Cargill's Food City network, was cash rich, and therefore Cargill's Bank was given a rating of something like A+, whereas other aspects probably would have been weaker. This is merely the best support that they can have, a parent company supporting by way of cash infusion. So this is an example that I can give. So therefore, this credit rating announces to the world or the business world the strength of this particular institution, depending or going by the measurement of liquidity management, asset quality, access to liabilities, management capabilities, etc., so that others who want to deposit money or do transaction with these entities can make a considered decision. Usually the credit ratings are expressed in these terms. AAA is the best, then comes AA plus or AA1, then AA, then AA minus, then A plus, then A, then A minus. Again, to start, BBB plus, BBB, BBB minus. Up to that point, the credit rating is supposed to be investment grade or acceptable to the investors. Then BB plus or 1, BB minus, B plus, B minus, CCC. Now this Sri Lanka country rating stands somewhere around CCC now. CCC. So these ratings are supposed to be non-investment grade. And when they want to borrow money, they have to pay a premium, higher premium over the investment grade institutions to borrow money, because these investment grades reflect a weak performance as measured by these criteria. Okay. Let's now talk on the corporate governance. Sarbanes-Oxley is Parliament Act brought in by the United States when they found that Enron and WorldCom and Tyco companies misled the regulators and the investors by way of accounting errors, and the internal auditors and external auditors were also either unable to locate such errors, or purposely they were also party for the hiding of the factual truth. So basically, corporate governance means that the shareholders and the general public should be informed of the facts which are not altered or not misled. The true picture must be shown. So the board of directors, board subcommittees, and the senior management are liable to do an honest job, not hiding the profits, not hiding the fraudulent activities. Furthermore, they should, in terms of corporate governance provisions, the board of directors, the senior management of financial entities should be publishing how they propose to serve the general public and the shareholders. They must put up how best they would serve by way of accepting deposits or accepting investors' money and then pooling them, and then also on lending or serving the community to increase the living standards of the general public. So that is, in short, corporate governance. So as a result of Enron and WorldCom investigations, United States brought in Sarbanes-Oxley Act or SOX Act in 2002. However, in Sri Lankan standards, we have so much other regulatory provisions to protect the entities, under corporate governance. So basically, corporate governance rules and regulations or regulations are to protect shareholders and the general public from accounting errors and fraudulent practices in enterprises, and to improve the accuracy of corporate disclosures. The Act sets the deadlines for compliance and publishes rules on requirements. Basically, all public companies must comply with the Sarbanes-Oxley Act, both on the financial side and the IT side, because IT is used very much on to process the financial figures and the statistics. The way in which the IT departments store corporate electronic records change as the result of Sarbanes-Oxley Act. Now, under Sarbanes-Oxley Act, in US, those records must be maintained for 5 years minimum. But in Sri Lanka, under the Financial Transaction Reporting Act, those records must be maintained for periods more than 6 years, or a minimum of 6 years. And consequences for non-compliance include fines and imprisonment or both. So in Sri Lankan standards as well, the financial penalties and the imprisonment or both can be applied for violating regulations. So in Sri Lankan standards, directions under Montreal Act 1949, Banking Act 2008, issued by the following, then the regulation issued by the following departments: Director Bank Supervision, Director Non-Bank Supervision, Director Foreign Exchange, Director Payment and Settlement, Director FIU, Superintendent of Public Debt, and other directives issued by the SEC, Colombo Stock Exchange, Chartered Accountancy Institute, and SWIFT, also material fact to protect the corporate governance stature of the financial institutions. In particular, the Financial Transaction Reporting Act, FTRA number 6 of 2006, records must be maintained for minimum 6 years. Customer charter directions, prompt and precise customer information must be sent to the depositors and investors and the shareholders of financial entities. Customer charter direction in particular wants to show the general public that how best they would serve their products and services to the general public, including those so-called disabled customers moving around in wheelchairs should be provided with easy access to the branches and offices, and they should be given prompt attention and due recognition in their business transaction with the entity, in the products and services. At the same time, the clergy and the senior citizens should also be given decent and prompt attention. Furthermore, those illiterate people who cannot read or write must be provided with honorable services of special attention by a senior officer, so that they don't lose their trust on the organization. On top of that, there should be proper directions, proper guidance for any customer who is not satisfied with the services and the products offered by the entity, for a complaining process or complaints resolution process. There should be a complaint resolution officer, a senior grade personnel dedicated for receiving customer complaints and implementing resolution or resolving the complaint victimized customers. And if not satisfied, the customer should be provided with information to approach the financial ombudsman. Financial ombudsman is mostly a retired judge officiating on a mini court to receive complaints and summon the relevant officers on a customer complaint and the customer to one forum and listen to the grievances of both sides and bring about a judgment or resolution. And if still the customer is not happy, they should be directed to take the judicial path by way of filing by way of suing the entity, financial entity, or the officers in a magistrate courts or high court, as the case may be. Then there again, know your customer directions by the Financial Transaction FTRA, Financial Transaction Reporting Act itself, is also a very important Parliament Act, and the beneficial law owner directions is also emanating from the FTRA. They all provide protection for the depositors and the investors. So corporate governance, I explained, then disaster recovery procedures, also direction by the Payment and Settlement Department, where disaster recovery sites or business continuity arrangements must be set up, and then tested on a frequent basis, so that any eventuality of disruption of services from the main location or usual location, the services should be resumed at the disaster recovery site. Then baseline security standards directions, especially with regard to the information technology, the servers, firewalls, encryptions, password controls, menu controls, and the communication line encryptions. Those standards must be observed, followed, and then implemented. Then finally, net open position direction, where authorized dealers, licensed commercial banks, or restricted dealers are given certain level of exposure or bought or sold to be adhered to. If at all, if they want to exceed the overbought or sold exchange positions, they need to seek approval from higher authorities, and finally of the regulator if they are to violate the regulator's stipulated net open position requirement. So these regulations are in force. So they are much more comprehensive than what is prescribed in the United States by the Sarbanes-Oxley Act. All right, so this set of slides on Treasury overview were complete. If there are any observations, any questions, you may ask now, or else I had to load the next set of slides. This is about the treasury functions and monitoring, which is very important. I explained a little bit at the last slide that I discussed. But when we understand that most of the treasury personnel, particularly the front office people, the middle office people, and the back office people do not understand and had more or less ignored the monitoring aspects. I have brought this slide again to show the segregation of the treasury activities. Why is this treasury very important in a financial intermediary, licensed commercial bank or licensed specialized bank or a finance company or insurance company or a primary dealer? It is important because treasury is the place entrusted to manage the wholesale banking part or pooled fund or the pool of funds. Slight deviation on a rate, exchange rate or interest rate or any other value date, there can be a sizable loss or damage. Such damages will finally accrue to the financial performance, and the society at large or the economy at large will be impacted. Final economic growth or GDP growth of the country will be affected. So therefore, Treasury front office executing transactions, Treasury middle office aligning the risk versus return, and treasury back office to record performance, compare, and then the report. In all three cases, where the compliance is to monitor and review the suitability, applicability, and the progressiveness should be measured by the compliance, and appropriate action, at least by way of reporting, should be taken. It is appropriate to mention at this point in time, compliance, or the head of compliance has the power to recommend and change the personnel involved in the treasury front office or the middle office and the back office. If they are found to be behaving irrationally, inappropriately, or unprofitably, then the compliance role is that to identify and report such incidents to the HR, to the board subcommittees, and the main board, and make alternate arrangements in place of such personalities. So this is very important. Why do you need a middle office? The recent events have shown that fundamental failings in internal controls can result in severe financial losses or even insolvency in financial institutions. Robust controls need to be in place to ensure transactions are undertaken in accordance with appropriate strategies, policies, and the procedures of the bank or the financial institution. The middle office typically gets involved in the risk management and control aspects of the trading and is staffed with people who are capable of independently valuing portfolios and analyzing risk positions, with responsibility to minimize losses and maximize profits. So basically the risk managers in the middle office should be aware of the strategic goals and commenting or reporting any violations or deviations from the set goals. So therefore, treasury front office guys or the dealers should not think that they are the superhumans and that others do not understand what they do. It is not the game. It is the middle office focus and the attitude that should bring about the justice, fairness to the institution. As I said before, each transaction carried out by the front office, there is a cost of at least 3,000 to 5,000 rupees to the organization. And such costs at a minimum should be covered in each transaction, let alone the strategy to minimize the losses and maximize the profits. So therefore, it is not a matter of executing 10 transactions, 50 transactions, 100 transactions, 1,000 transactions a day. But each one of those transactions must bring in economic rationale, and they should be, the purpose of those transactions should be to minimize losses and maximize profits. So if the middle office personnel do not understand this, and then in case if they do not understand or know the economic goals decided or set by the board of directors and the board subcommittees and the ALCO, they are not fit to be in that position. As of the authority levels, the middle office personnel or risk managers has the authority to instruct the treasury front office dealers to reverse an agreed or executed deal transaction if they feel that such transactions are not in line with the economic rationale or set goals, and then if they are not minimizing the losses or maximizing the profits for the institution. So they can request the treasury front office person who executed the transaction or question him and ask him to reverse such transaction with the concurrence of the counterparty if they are not in line with the agreed norms or set goals. Middle office functions are closely connected and located very close to the front office, entrusted with monitoring, controlling, and providing information on the front office functions and with the actual origination of the transactions. Middle office functions includes risk monitoring, measurement, management, control, and reporting. You might be wondering why these finer points are discussed at your money broking certificate course. Because you all are intermediaries or facilitators to the treasury front office transactions. You do serve the capabilities of the execution of transactions by the treasury front office of banks and primary dealers. Therefore, your knowledge about the setup and the roles of the treasury front office as agreed or as required by the board of directors and the board subcommittees and also the regulators, the money broker should know. Money brokers at a later date can be partly responsible if by any chance treasury front office personnel with their irrational behavior and then methodology of operating or executing deals or transactions had contributed to the downfall of any organization. If in such case, as facilitators, money brokers are or may also be contributory or partly responsible. If you guys observe such things happening in the market at the office of a certain bank or a primary dealer, then you will have the right to pinpoint or highlight or whistleblow to the authorities at that particular organization or at the central bank, whether it is domestic operation department or international operation department, public debt or bank supervision department or non-bank supervision department, because all of them might not have the first-hand information of transactions carried out in such a manner. So therefore, if you have the slightest knowledge of such transactions, it is your responsibility to enlighten such authorities who could make an impact and change course. Then you will be preventing or avoiding collapse of an institution, finally huge black mark and the loss to the economy at large. So therefore, it is also a bounden duty of money brokers to identify and report such wrongful behavior. So the Treasury Middle Office role and responsibility, we explain a lot. Basically, the role is to verify applicability of transactions carried out by the front office. Responsibility, again, I explained that if they are not the transactions are not in line with the economic rationale, they should be intervening and then reversing such transactions. Role of the middle office: analyzing the inherent risks in business activities, keeping track of price movements, evaluating the effectiveness of control systems, forecast, simulations, sensitivity analysis, stress testing, performance measurement, and performance attribution. The middle office, their role includes all this. Then the responsibilities of the middle office include risk monitoring, risk measurement, risk management, risk control, and reporting. Risk monitoring, limits and ratios, the counterpart limits, loss limits, product limits, and the rate reasonability, how much it is deviated from the current market rate, rate reasonability. And then also in comparison to the portfolios that the bank or the financial institution maintains, the transaction rate, whether it is reasonable or not. Again, another way of expressing the economic goals or economic set goals or economic rationale of the transactions. Then the trading investment positions under SLFR is 9 and LKS 39, issued by the Institute of Chartered Accountants of Sri Lanka. Sri Lanka Financial Reporting Standards and Lanka Accounting Standards. Under that, for investment portfolios to be categorized under 3 business models: held to maturity, available for sale, and held for trading. Held to maturity, under the classification, any treasury bill, treasury bond, or share portfolio, or any other debenture or corporate bond, any other investment that is bought with the intention of receiving the cash flows only, and then to keep till the maturity, not for sale. Those should be categorized under held for maturity, or HTM. Held to maturity portfolios are typically in Sri Lankan standards. Any treasury bill, treasury bonds in that portfolio could be used or are used for the purpose of assigning to the central bank for intraday liquidity facility, ILF, and any other repo, reverse repo category purposes, it can be used. Then the second business model, available for sale, again, expectation only the cash flows, and on a rare basis, an investment can be sold. And in these 2 business models, HTM and available for sale, or AFS, the mark-to-market gains or losses or unrealized values are taken into the balance sheet directly, not to the P&L. So therefore, the front office dealers should not be allowed to mainly sell these instruments which are in these 2 portfolios frequently, because the resultant capital gain or capital loss do not go through the P&L, they go through the balance sheet. But the third category, held to maturity, held for trading, HFT, held for trading, is meant for short-term engagement or short-term investment category with a view to make capital gains or losses. But there can be limits of holding period. Any invested treasury bill or treasury bond or share market investment under HFT, there can be, should be sold within 30 days or 60 days or 90 days. Anytime within that period, it must be sold. They cannot be carried on for longer period than that. But the resultant capital gain or loss will be routed through the P&L. And therefore, to measure the performances of the front office dealers, mostly capital gains and losses generated through the HFT portfolio, health trading portfolio, is used. When they have made a lot of money, capital gains, they can be given a performance bonus because they have shown their skill. So therefore, health trading portfolio is important for the treasury front office guys to make additional personal income as well. Then, but not on the HTM and AFS, but only the HFT. Then front office and back office operation also must be monitored by the middle office for risk monitoring purposes. These type of controls are required because we have heard a lot of activities that have brought ill reputation to the organizations, sometimes losses, huge losses as well. And then in the international market, we have heard cases like Barracks Brothers. They are a front office guy, the name of Nick Leeson, was instrumental in bringing down Barings Brothers, the merchant bank, about 150 years old merchant bank, where the Queen, British Queen and the royal family was banking with. Well, Nick Leeson made a loss of more than the capital of the total capital of the bank. Finally, the Bank of England did not intervene to save the bank. So what happened was later on, it was sold for just £1 to a Dutch bank because of the huge amount of accumulated losses. So therefore, to prevent such activities only, these type of controls are brought in. Then the limits. Again, risk monitoring limits. The limit structure can be appropriate to the organization or suitable to the organization, but it will include single transaction limit. A transaction by a certain individual, dealer, or on a product, there can be a single transaction limit. Overall currency position, overbought, oversold, overnight, daylight limits. Then in individual currency positions, overbought, oversold, overnight, or daylight. Then forward foreign exchange mismatch gap limit. The gap between certain maturity dates, a maximum limit can be enforced. It can be said spot against 3 months, or 1 month against 3 months, or 3 months against 6 months. Mismatch cannot be more than $10 million or 100 million rupees or something like that. So the forward foreign exchange mismatch will help to iron out any drastic build-up of under certain forward date. then overall loss limit for a day, overall loss limit for a day, or overall loss limit per transaction, then cumulative loss limit for a month, dealer limits. For each and every organization, the risk managers, the compliance managers can get involved in setting up such limits. And limits and ratios, maximum tenor, say treasury bills and treasury bonds more than 10-year maturity cannot be touched, or 5 years maximum. Then value at risk limits. Value at risk means when given a certain investment compared with the market rate, the maximum value at risk should be a certain amount only. There can be limit. And then the methodology of measuring value at risk could be also described, how to arrive at the value at risk. And when the limit is set on a certain mark, the value at risk cannot exceed that limit. Then counterparty exposure on foreign exchange and money market. Counterparty settlement on foreign exchange and money market. Country limit. For each sovereign country, going by the individual country's credit rating and then reputation, there can be limits imposed. One thing I discovered was that when you talk of counterparty limits, there were some institutions and senior high-profile risk managers were also arguing that there shouldn't be a counterparty limit for a treasury bill or treasury bond transaction. The argument that they brought forward was, when you sell a treasury bill, you are given rupees. When you buy a treasury bill, you give rupees. So the value exchanged. So therefore, there need not be a counterparty limit as such. But the issue is that when you agree on a forward date on a transaction, that particular counterparty may not be in existence at the time of the maturity for them to deliver the treasury bill, treasury bond, or the rupee value. So as far as you are concerned in your entity, you have adjusted your cash flows and recorded transactions on that value date. But when the value date arises, that particular entity is no more in existence. So therefore, when there is no limit imposed on treasury bill, treasury bond transactions, your organization may have to well cover those transactions with somebody else at a new rate, which can be a different rate to the original agreed rate with that entity which has gone down. So therefore, the knowledge and understanding must be improved all the time when certain lack of knowledge is seen. So such identification of lack of knowledge also can be done through the monitoring part by the middle office or the internal audit or external audit or the compliance department of the financial entity. Then you have some other limits such as foreign borrowing, maximum 15% of the capital funds. Foreign borrowing is limited because of various reasons. Because foreign transactions can be with certain unforeseen risks. Then foreign exchange exposure as percentage of total capital funds, not to exceed 30%, for example. Then swapped fund ratio. Now, swapped funds is exchange of one currency to another currency for a temporary period of swap, as against the funds generated through the deposits taking or acquiring of deposits. Swap funds involves, say, US dollar to rupee. If one entity has dollar depositors and then they decide to sell $1 million or $10 million for a period of 1 month or 3 months against rupees, and if it is $1 million, 200 million rupees will be generated, but the liability book in this particular institution, depositors liability is in dollars, whereas now you are in possession of the rupees for that amount. In case the depositors demand funds within that period, you will have to locate and procure dollars at whatever the market rate in order to fulfill the withdrawal demand by the depositor. So therefore, to avoid such risks, only swap fund ratio is set. The liquid asset ratio, the assets that you are holding should be in liquidity, most liquid manner, and classified liquid assets by the central bank, mainly known as small cash, treasury bill investment, treasury bond investment, and then short-term trade finance bills, where 1 month or up to 3 months bills, which can be recovered within that short period, can be called liquid assets. The total of liquid assets should be minimum of 20% of the total liabilities, total liabilities, yes. So that any room for liquidity crisis is avoided. Loans to deposit ratio. I think we discussed at the outset, when the deposits are taken in or deposits are acquired, total deposits cannot be lent as loans, because depositors are in the habit of coming up and showing up at the counters or the branches and demanding withdrawals a certain percentage on a daily basis. So there should be a certain amount of vault cash maintained to meet such withdrawal requests. If you have to on-lend the total deposits accepted, then there is going to be a problem of liquidating part of the loans to honor the withdrawal demands. So therefore, by experience and practical information, bankers and finance companies on-lend only about 60 to 70% of the total deposits that they took as deposits. So always the ratio loans amount should be about 60% or 70% of the total deposits accepted. Balance money can be in liquid form in treasury bills and treasury bonds, which can be liquidated on a very short information. But granting loans should be limited to 60 or 70%. Processing time. Deal processing time is monitored to avoid undue delay in capturing authorizing deals to the system. This is one point where any amending transactions can be avoided or for fraudulent purposes. So we know that we discuss and we know that central bank has imposed a time limit of 15 minutes or something for money brokers to record their transactions in the central bank system. So likewise, in the treasury dealing rooms, in banks and finance companies, also there should be a processing time limit, so that any possibility of taking longer time and adulterating or amending or manipulating transaction details can be avoided. Rate reasonability test. Check through system parameter setting, broker data, Reuters, Bloomberg. So with the use of such data systems, the amount of variation from the market rate can be ascertained. That is to check with the off-market rate concept. However, this applies to the portfolio values and rates, average rates. The rate reasonability check should be against the portfolio rates as well, say average portfolio rates, because that may also be attributable to or manipulated by the treasury front office guys to pass on certain amount of benefit to the other side of counterparty, so that off the record the counterparty will compensate the treasury deal of this particular entity for agreeing to transact at that particular deviated rate from the market rate. So these are the finer points of practical understanding to be monitored and to be checked when it comes to middle office verifications. Front office operations. Front office and back office must be independent. Front office personnel should not walk around in the back office. Back office personnel should not be permitted to enter into the front office. The communication can happen only via telephone or other way around, other means. This is to avoid any undue interactions and professional standards to be maintained. Then the customer dealing of the front office personnel should also be monitored. Proprietary dealing based on banks' risk capital should be also checked. Managing bank liquidity is also utmost important and should be closely monitored by the middle office. Then the back office operations, deal input and verifications. There should be a risk monitoring whether the total number of deals executed had also been verified and input to the systems. This verification can be performed by the middle office or the risk managers, because there can be transactions carried out but may not have verified and input to the system at the end of the day, which can be a huge error, and the total deal amounts from the cash flows can be missing, whereas actual money may have gone out or become liable by the entity to be paid to other counterparties. The deal verifications by confirmation, by checking the confirmations, also is a risk monitoring check. Then the settlement, SWIFT messages originated for effecting payments or SWIFT messages originating, requesting payments or receive payment should also be checked. Then Nostro account reconciliation is usually done by a separate team, and they will be part of the team of the back office in most cases, and should be done by the earliest possible time or as soon as possible, so that the value or total amount of money to be received and or paid and the timing, the date, value date, can be cross-checked, because any delay of such funds or short or in excess can cause interest payments or interest claims. Risk measurement, position valuation, each and every position, the fund's position and the exchange position. Valuation reports must also be checked by the middle office. Mark to market of trading positions, market volatility and frequency of position valuation, then the methodologies, repricing, fund gap model, maturity model, duration model, and value at risk model. Most institutions may not use all these methodologies, but at least one or two effective models should be used. Risks management, liquidity risk, market risk, interest rate risk, foreign exchange risk, credit risk, meaning counterparty risk, should be monitored. Liquidity risk. Liquidity risk management refers to the timely availability of funds to the bank or financial institution when needed without incurring any penalty or costs. This arises from two sources, that is liability side and asset side. Due to mismatches in the assets and the liabilities of the bank or financial institution, liquidity risk management focuses on gaps on existing facilities and the ability to borrow at future date, to refinance or raise new debt to fund the gaps at more favorable pricing and maturity terms. These are very practical situations, but you would understand if you are really practically handling such portfolios. However, the transaction that arise out of the banks and the primary dealers mostly arise to cover the due mismatches in either assets or liabilities. And due to the nature of the urgency, the favorable pricing and maturity terms would vary depending on the market availability. Liquidity risk management, maintenance of statutory ratios, liquid assets ratio, foreign borrowing to capital fund ratio, then internal targets and ratios, cap on interbank call borrowing, loans to deposit ratio, swap fund ratio, contingency funding plans. So liquidity risk management, all these are considered. Risk management, market risk. Market risk is the potential that changes in the market price of an institution's holding may have an adverse effect on its financial condition. The four most common market risk factors are interest rates, foreign exchange rates, equity prices, and the commodity prices. So the market risk management, identifying the relevant market risk factors for a particular product, portfolio, or business proposition. Limits and all treasury products are approved by the board of directors. Setting and monitoring appropriate levels of limits. Then applying an appropriate limit structure to aggregate portfolio limit, holding period limit for trading securities, maximum tenor limits, range of permitted currencies, commodities for each instrument and product. interest rate mismatch amounts, foreign exchange open position amounts, and stop loss limits to be accompanied by maximum tenor period limits. Ensure clear defined authorized instruments and permissible hedging and position taking strategies are undertaken. Then, most importantly, gap reports to be used for monitoring to be constructed in the following time bands. These time bands, each and every institution can choose different time bands, but more commonly used time bands for the gap reports are daily, first 5 days, weekly, second, third, fourth weeks, monthly, 2 to 12 months, and annually. The gap reports, the receipts and payments on each currency is compared and the excess or shortfall is ascertained, and a cumulative position is also ascertained. Risk reporting, preparation of risk reports to capture all trading activities, position reports with sensitivity analysis, exception reports for limit breaches, maturity gap analysis, preparation of treasury P&L, stress testing reports. So most of these reports are prepared in the front office and the middle office. And sometimes the back office also may chip in producing certain reports. And they should be shared with the important authorities and explained. So finally, just to remind again the importance of segregation of duties between front, middle, and back offices, and the authority that is maintained should be maintained by the middle office or front office, back office or front office, and the middle office or back office again. And finally, the compliance should be monitoring and reviewing the operations of all three units. Okay, that helped me to conclude that slide presentation as well within the time limit. All right. Any question? If there are no questions, any comments? If there are no comments, how about the assignment topics? So will you all come out and inform me the assignment topic chosen by tomorrow?
Yes, sir. Sure, sir.
Right, thank you. Thank you, Niluk, and thank you, Trevor. All right, so I'll wait till tomorrow to hear from you. Okay, those who have chosen the topics, please start working on it. And all the team members should be contributing towards that. So therefore, we can expect a successful assignment this time as well. Okay, then. Thank you very much.